Markets look stable right now. Indexes are holding up. Volatility is subdued and price action appears orderly. To most retail investors, that stability feels reassuring. It suggests that the system is functioning, risks are contained, and whatever problems exist are already known and priced in. But history shows that this is often the moment when perception and reality begin to diverge. Institutions do not interpret stability the same way retail investors do. For them, stability is not a signal that risk is gone. It is often a signal that risk is being absorbed quietly, displaced into areas that do not immediately show up on price charts or in daily headlines. When markets look stable during periods of rising debt, tightening liquidity, and structural imbalance, institutions do not relax. They reposition. This difference in interpretation is critical. Retail investors tend to focus on what prices are doing now. Institutions focus on what prices will be forced to do later once underlying constraints assert themselves. That gap between surface stability and underlying pressure is where most market repricing begins. To understand why institutions see something different, we need to step back from daily price movement and look at how financial systems actually behave under stress. Systems do not fail all at once. They degrade. Pressure accumulates, buffers thin, and risk migrates from visible markets into less visible ones. Stability at the surface is often a sign that stress has not been resolved, only postponed. One of the most common misunderstandings in markets is the belief that low volatility equals low risk. Volatility is not risk itself. It is a signal of risk being expressed. When volatility is low, it often means risk is being suppressed rather than eliminated. Institutions understand this because they have seen the pattern repeatedly. Calm conditions do not remove imbalance. They allow imbalance to grow. This is why institutions rarely chase stability. They question it. When prices are stable in an environment where costs are rising, leverage is high, and liquidity is tightening, institutions ask a different question than retail investors. They do not ask, why isn't the market reacting? They ask, where's the stress going? To answer that, it helps to use a simple framework that appears again and again across financial history. First, an imbalance forms. This could be excessive debt, overextended supply chains, or promises that exceed productive capacity. Second, policy and liquidity are used to smooth volatility and maintain confidence. Third, stress migrates beneath the surface into balance sheets, inventories, funding markets, and settlement systems. Finally, once constraints are reached, repricing occurs. We are currently somewhere between the second and third stages of that process, and this is where institutions tend to act very differently from retail investors. Retail investors usually respond to visible signals. They react to headlines, price moves, and narratives. Institutions, by contrast, respond to structural signals. They monitor funding conditions, inventory levels, credit spreads, and counterparty behavior. These indicators often deteriorate quietly while headline markets remain calm. Take debt as an example. Globally, total debt has reached levels that are historically extreme. Governments, corporations, and households all expanded leverage aggressively during years of low interest rates. Those obligations did not disappear when rates rose. They remained embedded in the system. As rates reset higher, the cost of servicing that debt increases, even if prices remain stable. From a retail perspective, stable markets suggest that higher rates are being absorbed. From an institutional perspective, rising interest expense is a slow-moving pressure that reduces resilience over time. It does not cause immediate volatility, but it narrows the margin for error. Institutions understand that systems with narrow margins are vulnerable to shocks, even if prices have not yet reflected that vulnerability. Liquidity is another area where perceptions diverge. Retail investors often assume that liquidity is abundant as long as markets are trading smoothly. Institutions know that liquidity is conditional. It depends on confidence, funding availability, and the willingness of counterparties to intermediate risk. Liquidity can disappear quickly, not because of panic, but because conditions change. When liquidity tightens, the first signs rarely appear in equity indexes. They appear in funding markets, repo rates, collateral requirements, and bid-ask spreads in less visible instruments. Institutions watch these areas closely. Retail investors rarely see them at all. Inventories provide another important clue. Inventories are buffers that absorb shocks when supply and demand become misaligned. Over the past decade, global inventories across energy, industrial metals, and manufacturing inputs were deliberately reduced in the name of efficiency. Just-in-time logistics and cost optimization lowered visible waste, but they also reduced redundancy. From a retail perspective, stable prices suggest that supply is adequate. From an institutional perspective, low inventories mean that the system has less capacity to absorb disruption. Stability in a low inventory environment is fragile. It depends on everything continuing to work as expected. Institutions know that systems optimized for efficiency are often poorly prepared for stress. This is especially important in a global system. Modern markets are deeply interconnected. Stress rarely appears where attention is focused. A disruption in one region can propagate through multiple channels before it becomes visible in headline prices. Institutions map these linkages. Retail investors tend to look at individual markets in isolation. For example, tight physical supply in one country can lead to funding stress in another. Currency stability can mask trade imbalances until settlement pressure builds. Commodity shortages can remain hidden until delivery delays force repricing. Institutions track flows, not just prices. They want to know where material, capital, and risk are actually moving. Another key difference lies in how institutions think about policy. Retail investors often believe that policy intervention eliminates risk. Institutions see policy as a tool that changes timing and distribution, not outcomes. Policy can delay adjustment, but it cannot override structural limits. You cannot regulate your way out of arithmetic. You cannot legislate additional physical supply into existence. You cannot permanently suppress the cost of capital without consequences. When markets look stable in the presence of rising structural pressure, institutions do not assume that policy has solved the problem. They assume that policy has bought time. And time is valuable, but it is not infinite. This is why institutional positioning often looks counterintuitive to retail investors. Institutions may reduce exposure, build optionality, or shift into assets that benefit from dislocation, even while prices remain stable. Retail investors often interpret this as being overly cautious or out of touch. In reality, it reflects a different understanding of how systems fail. Institutions also think in terms of probability distributions rather than narratives. They do not need a specific prediction to adjust positioning. They only need to recognize that the distribution of outcomes has shifted. Stability with rising underlying pressure increases the probability of nonlinear outcomes. That does not mean a crisis is imminent. It means that the tail risks are growing. One of the most dangerous moments in markets is when stability becomes consensus. When most participants believe that risks are known and contained, positioning becomes crowded. Hedging declines, leverage increases, the system becomes optimized for continuation. That optimization makes it efficient, but also brittle. Institutions are acutely aware of this brittleness. They have lived through periods where markets appeared stable right up until they weren't. The global financial crisis did not begin with a dramatic equity crash. It began with small failures in funding markets. The European sovereign crisis did not begin with panic in stocks. It began with rising yields in peripheral bonds. Calm masked vulnerability. This historical memory shapes institutional behavior. Stability does not reassure them. It sharpens their focus. Another factor that separates institutional thinking from retail thinking is time horizon. Retail investors often operate on short-term feedback. They respond to daily or weekly price movement. Institutions often operate on multi-quarter or multi-year horizons. They are less concerned with whether markets move tomorrow and more concerned with whether the system S trajectory is sustainable. When institutions look at current conditions, they see multiple pressures converging. Debt servicing costs are rising. Demographic trends are unfavorable in many developed economies. Energy and resource constraints remain unresolved. Global trade is fragmenting. Geopolitical risk is increasing. None of these factors require immediate repricing, but together they reduce the system's capacity to absorb shocks. Markets can remain stable for extended periods in such an environment. Stability itself is not the problem. The problem arises when stability is mistaken for safety. The key insight here is that institutions are not waiting for visible stress to act. They are responding to invisible stress. They are watching where buffers are thinning, where flexibility is declining, and where assumptions are becoming fragile. Retail investors tend to see stability as confirmation. Institutions see it as a question mark. This does not mean institutions are predicting an imminent collapse. It means they understand that systems under pressure rarely fail loudly at first. They fail quietly, in places most people are not watching. In the next, we will look more closely at the specific indicators institutions monitor during periods of apparent stability, how these signals differ from retail-focused metrics, and why repricing often begins away from headline markets. Not predictions, not timelines, just mechanisms and signals that help explain why institutions see something different when markets look stable. If institutions see something different when markets look stable, the obvious question is what exactly they are watching. The answer is not a single indicator or headline. It is a collection of pressure points that rarely attract attention until they begin to fail. Institutions understand that market stress does not disappear, it relocates. And the most important signals tend to appear where liquidity, leverage, and physical constraints intersect. One of the first areas institutions monitor is funding. Markets can look stable even as funding conditions quietly tighten. Short-term funding markets are the circulatory system of modern finance. They allow leverage to function and positions to roll forward. As long as funding is abundant and confidence remains intact, prices can stay calm. But when funding becomes more selective, even without panic, the system becomes more fragile. Retail investors usually assume that as long as markets are trading smoothly, funding must be fine. Institutions know that this is not necessarily true. Funding stress often appears as higher rollover costs, stricter collateral requirements, or reduced balance sheet capacity among intermediaries. None of these immediately show up in equity prices, but they directly affect the system's ability to absorb shocks. Another area institutions focus on is balance sheet quality. During calm periods, balance sheets tend to expand. Leverage increases because volatility is low and risk appears manageable. This expansion is not inherently dangerous, but it reduces flexibility. When balance sheets are extended, even small disruptions can force adjustments. Institutions pay close attention to how much room remains before constraints are hit. This is especially relevant in an environment where interest rates have risen after a long period of suppression. Higher rates increase the cost of carrying leverage. Even if prices remain stable, the economics of holding risk change. Institutions understand that this pressure accumulates gradually. It does not require a dramatic trigger to matter. It simply reduces resilience over time. Inventories remain another critical signal. Institutions track not just whether inventories are low, but where they are low and how quickly they can be replenished. In many sectors, supply chains have become more complex and geographically fragmented. This increases efficiency under normal conditions, but it also increases vulnerability. When inventories are thin, stability depends on uninterrupted flow. Retail investors tend to assume that supply chains will adjust automatically. Institutions know that adjustment takes time, capital, and coordination. When inventories are low, the system has less margin for error. Stability in such an environment is conditional, not robust. Derivatives exposure is another area where institutional awareness differs sharply from retail perception. Derivatives allow risk to be transferred, but they also create dependency on counterparties and settlement systems. During calm periods, derivatives usage often expands because hedging appears cheap and volatility is low. This increases interconnectedness. Institutions understand that interconnected systems can function smoothly for long periods and then fail quickly when confidence shifts. The issue is not the existence of derivatives, but the assumption of continuous liquidity and performance. When markets are calm, those assumptions go unchallenged. Institutions watch for signs that they may no longer hold. Another important distinction lies in how institutions interpret price signals. Retail investors often view prices as a complete summary of information. Institutions view prices as one signal among many. They understand that prices can be distorted by policy, positioning, and short-term incentives. Stability in prices does not guarantee stability in the underlying system. This is particularly relevant when policy plays an active role in shaping market behavior. Policy tools can smooth volatility and support confidence, but they also influence incentives. When participants believe that volatility will be contained, they adjust behavior accordingly. Leverage increases, buffers shrink, and risk becomes more concentrated. Institutions are aware of this feedback loop. They understand that policy-induced stability can create its own vulnerabilities. The goal of policy is often to buy time. Institutions ask how that time is being used. Is the underlying imbalance being reduced, or is it growing? Another area institutions monitor closely is cross-market behavior. Stress often appears first in markets that receive less attention. Currency markets, commodity delivery markets, and credit spreads can reveal shifts in confidence before equities react. Institutions look for divergences. When one part of the system signals strain while others remain calm, it suggests that stress is being redistributed rather than resolved. Global linkages amplify this effect. Capital goods and risk flow across borders. A disruption in one region can surface elsewhere before it becomes visible at home. Institutions track these flows. Retail investors tend to focus on domestic headlines. Institutions think in terms of networks. This network perspective is crucial. Modern financial systems are not linear. They are adaptive and interconnected. Stability in one node can mask instability in another. Institutions understand that failures often propagate through unexpected channels. They prepare for this by maintaining optionality rather than chasing short-term stability. Optionality is a concept that retail investors often underestimate. It is the ability to respond to change rather than predict it. Institutions value optionality because they recognize that complex systems produce nonlinear outcomes. Stability today does not guarantee stability tomorrow. Optionality provides flexibility when conditions shift. This helps explain why institutional behavior often looks cautious during calm periods. They may hold higher quality assets, maintain liquidity, or reduce exposure to crowded trades. Retail investors sometimes interpret this as pessimism. In reality, it is risk management informed by experience. Another important factor is time horizon. Institutions are not trying to time market tops or bottoms with precision. They are managing exposure across cycles. They understand that the most damaging outcomes are not caused by missing short-term gains, but by being overexposed when conditions change abruptly. This perspective shapes how institutions interpret stability. Stability is not an endpoint, it is a phase. Institutions ask what comes next, not because they know the answer, but because they know that phases change. History reinforces this mindset. Many major repricing events occurred after extended periods of apparent stability. In each case, warning signs were visible, but they were not widely recognized. Funding tightened. Inventories fell. Balance sheets stretched. Prices remained calm until they didn't. Institutions study these patterns not to predict exact outcomes, but to understand mechanisms. They know that systems rarely fail at their strongest point. They fail when buffers are thin and confidence is high. This brings us back to the core difference between retail and institutional perception. Retail investors tend to see stability as confirmation that risks are manageable. Institutions see stability as a condition that requires explanation. Why are prices stable? What assumptions does that stability depend on? How fragile are those assumptions? These questions matter because they influence behavior. When stability is taken for granted, risk becomes concentrated. When stability is questioned, risk is managed. It is also important to recognize that institutions are not monolithic. They do not all see the same thing or act the same way, but they share a common framework. They think in terms of systems, constraints, and probabilities rather than narratives and headlines. This framework does not guarantee success. Institutions make mistakes like anyone else, but it does explain why their behavior often diverges from retail expectations during calm periods. Markets can remain stable longer than many expect. Institutions know this. They are not constantly betting against stability. They are positioning for a range of outcomes. They accept that calm can persist, but they do not assume it will persist indefinitely. The key takeaway from this analysis is not that stability is false or dangerous by definition. It is that stability is not the same as safety. Stability describes what prices are doing. Safety depends on how much stress the system can absorb. Institutions focus on absorption capacity. They watch where buffers are shrinking and where assumptions are becoming fragile. When markets look stable, they do not relax, they look deeper. As conditions evolve, the signals institutions monitor will become more visible. Funding costs, delivery delays, and cross-market divergences tend to surface before headline volatility returns. By the time stability breaks, positioning has already shifted. Understanding this difference in perception helps explain why institutional behavior often appears disconnected from retail sentiment. Institutions are not reacting to what markets are doing. They are responding to what markets will eventually be forced to do when constraints assert themselves. In the next analysis, we will map out the specific warning signals that tend to precede repricing, not as predictions, but as indicators of where stress is becoming concentrated. Because by the time markets stop looking stable, the most important adjustments have already begun.